You walk into your bank branch on a Tuesday afternoon, waiting in line behind 7 other people, just to ask about reducing that monthly maintenance fee. That keeps eating into your checking account. The teller barely makes eye contact, hands you a pamphlet, and tells you the fee is non-negotiable unless you maintain a minimum balance you can't afford. You leave feeling frustrated, invisible, just another account number in their system. Meanwhile, someone else walks into that same bank, gets greeted by name at the door, escorted to a private office with coffee and pastries, and sits down with a dedicated advisor who manages their entire financial life. Same bank, completely different universe. What is the difference? It is not luck. It is not connections. It is 3 specific wealth thresholds that fundamentally change how financial institutions see you and treat you. I am Jason, and I've spent over a decade researching how the banking system really works behind the curtain. I've interviewed private bankers, analyzed fee structures across dozens of institutions, and discovered the exact numbers where everything shifts. If you are tired of feeling like banks are working against you instead of for you, you are going to want to hear this. Don't forget to subscribe and hit that like button because I share these insider perspectives regularly. And trust me, the financial industry doesn't want you knowing most of this stuff. Here is what most people don't understand. Banks operate on a tiered service model that is largely invisible to everyday customers. They've identified 3 critical net worth levels, where the profitability equation changes, and once you cross these thresholds, you are suddenly worth investing in. You stop being a cost center and become a profit. Opportunity. And when that happens, the fees disappear, the services multiply, and suddenly you have actual leverage. These 3 levels are roughly $100,000, $250,000, and $1 million in investable assets. Not your home equity or your car, liquid or semi-liquid assets they can actually work with, and at each threshold, a different door opens. Let me show you exactly what I mean with real examples. At the first threshold, around $100,000 in total, net worth or $50,000 to $100,000 in deposits and investments. Something subtle but significant happens. You become eligible for what banks call preferred banking or relationship banking programs. Sarah, a middle school teacher I know, hit this level after 5 years of aggressive saving. She had been paying $12 monthly for checking, $35 overdraft fees occasionally, and getting basically 0 interest on her savings. The moment she consolidated her accounts and crossed that $75,000 mark in combined deposits, her bank offered her a relationship package. Monthly fees vanished. She got free checks, free wire transfers, better interest rates on savings, and access to a dedicated phone line that actually answers. Over a year, she calculated she saved about $380 in fees alone, plus earned an extra $200 in interest compared to her old account structure. That is $580 annually, just for crossing an invisible line. But here is what really changed. She started getting calls about opportunities, CDs with promotional rates, pre-approved credit lines at better terms. When she wanted a car loan, instead of filling out an application online and waiting 3 days, she called her relationship banker who pushed it through in 4 hours at a 1/4 point lower interest rate. On a $25,000 car loan over 5 years, that small rate difference saved her nearly $400. The bank didn't suddenly become generous. They just recognized she was now profitable enough to compete for. The second threshold, around $250,000 to $500,000, is where things get really interesting. This is where you enter private banking territory at many institutions. My friend Marcus, a software engineer, crossed this line 2 years ago. He had been banking the same way for years, managing everything through apps and a TMIS when his investment accounts plus savings hit $320,000. He got a letter inviting him to join the private client division. Suddenly, he had a private banker, not just a relationship manager. This person knew his name, his goals, his family situation. They called him quarterly just to check in. When Marcus wanted to buy a house, his private banker coordinated everything. The mortgage team came to him. They offered rate discounts because of his relationship. They waived appraisal fees, application fees, and expedited the underwriting. Marcus estimated the fee waivers alone saved him $1,200, and the rate discount saved him roughly $15. over the life of his mortgage compared to what he was seeing advertised online. But the real value was access. He got introduced to estate planning attorneys through the bank's network. He received invitations to exclusive financial education seminars. When he had a complicated tax question about stock options, his private banker connected him directly with the bank's wealth planning team for a free consultation that would have cost him $500 elsewhere. The bank even assigned him a dedicated person to handle any service issues. His debit card got skimmed once while traveling, and instead of the nightmare stories you hear about frozen accounts and weeks of hassle, his private banker had a new card overnighted to his hotel and personally ensured his account was credited for fraudulent charges within 24 hours. The third threshold, $1 million and above, is a completely different stratosphere. This is where you access true wealth management services. I interviewed a banker who works in this division, and she told me something striking. At this level, the bank stops thinking about you as a customer and starts thinking about you as a partner. They're managing enough of your assets that their fees, typically around 1% annually, actually generate significant revenue. On $1 million, that is $10,000 a year to the bank. They'll invest heavily in keeping you happy. Jennifer, an entrepreneur who sold her business, entered this world at age 52 with about $3 million in liquid assets. She told me the difference was almost disorienting. Her wealth manager meets with her monthly. The bank provides comprehensive financial planning, covering everything from tax optimization to multi-generational wealth transfer. They coordinate with her accountant and attorney. When she wanted to buy a vacation property, the bank offered a portfolio line of credit at interest rates more than 2 points below standard mortgage rates, with no application process, no appraisal, and funding within a week. She gets free access to investment research that retail customers pay hundreds monthly to access. The bank's real estate division gave her off-market opportunities before they hit public listings. When her daughter needed help buying her first home, Jennifer's wealth manager arranged a family loan structure that was tax efficient and included legal documentation, all coordinated through the bank's resources at no additional cost. Most dramatically, the fees that nickel and dime regular customers simply don't exist in her world. Wire transfers, cashier's checks, currency exchange, safe deposit boxes, notary services, all complimentary. She calculated that services she now gets free would cost a regular customer over $2,000 annually. Now I know what you are thinking. This sounds great, Jason, but I am nowhere near these numbers. I am trying to figure out how to save my first $10,000. And you are talking about millionaires getting free wire transfers. How does this help me? Here is why this matters for you right now. Regardless of where you are starting, understanding these thresholds completely changes your banking strategy. Most people spread their money across multiple institutions. A checking account here, a savings account there, maybe an investment account somewhere else. They do this thinking they're diversifying or chasing slightly better rates. But by fragmenting their assets, they ensure they never cross these threshold levels at any single institution, which means they never access the benefits. Let me give you a concrete example. David had $8,000 in checking at Bank A, $15,000 in savings at Bank B because they offered 0.15% more interest, and $22,000 in a brokerage account at Firm C. Total assets, $45,000. But to each institution, he was a small, unprofitable customer. He paid $10 monthly at Bank A for checking, earned almost nothing at Bank B, despite the supposedly better rate, and paid trading commissions at Firm C. I suggested he consolidate everything at one institution where he could get close to that first $50,000 threshold. He moved everything to a bank offering a relationship package starting at $50,000 combined balances. He added $5,000 over the next few months from his emergency fund that had been sitting in a low-interest account. Once he crossed $50,000, his monthly fees disappeared. He got better savings rates that more than made up for the slightly lower rate he left behind. And he got access to commission-free trading in the first year alone. He saved $120 in monthly fees, avoided about $80 in trading commissions, and earned an extra $150 in interest because the relationship rate was actually better than what he had been getting. That is $350. which on a $50,000 base is a 0.7% return just from reorganizing. Not from investment gains, but you might be thinking, what if I don't even have $50,000? What if I am starting from zero or close to it? Then, understanding these thresholds gives you a clear target and changes how you think about your banking relationships. Instead of chasing $5 here or $10 there, you focus on building toward that first meaningful threshold. You ask your bank what their relationship banking requirements are. Many institutions have programs starting at $25,000 or even $15,000 in combined balances. You make that a goal. You stop thinking about your checking, savings, and investments as separate things and start thinking about your total relationship value to one institution. And here is something most people never consider. Many banks will calculate your pathway to the next threshold and give you some benefits early if you are clearly building toward it. If you are at $40,000 and consistently adding $1,000 monthly, a good relationship banker will often waive fees proactively because they can see where you are heading. I've seen this happen repeatedly. The bank would rather lock in a growing customer than lose them to a competitor. Some of you are also thinking, but what about online banks with no fees and better rates? Don't they make all this irrelevant? Online banks are great for specific purposes, and I use them myself for certain accounts. But here's what they can offer: relationship value and leverage. When you need a mortgage, a business loan, a letter of credit, help with a complex financial situation, or someone to actually advocate for you when something goes wrong, that app isn't going to help you. The banks I am talking about provide services and access that no-fee online platforms simply can't match once you reach these thresholds. The strategy isn't either or. It is using online banks for specific high-yield purposes while building your primary banking relationship strategically at an institution where you can cross these thresholds and access real leverage. Let me give you the practical action steps you can take starting today, regardless of your current financial position. First, calculate your total liquid net worth right now. Add up everything: checking, savings, investment accounts, CDs, money market funds. Don't include your home equity or retirement accounts. You can't touch. This is your baseline number. Second, research the threshold levels at your current bank or credit union. Call them or check their website for relationship banking, preferred banking, or private client programs. Ask specifically what the asset requirements are and what benefits you'd receive. Write down those numbers. Third, if you are spread across multiple institutions, run the math. Calculate what you are paying in total fees annually across all your accounts. Calculate what you are earning in interest. Then compare that to what you'd pay and earn if you consolidated to reach the next threshold at one institution. In most cases, especially once you are above $25,000 in total assets, consolidation wins. Fourth, set a specific threshold goal and timeline. If you are at $15,000 and the first meaningful threshold at your institution is $50,000, that is a $35,000 gap. If you can save $1,000 monthly, that is 3 years. If you can do $500 monthly, that is 6 years. Having a specific target changes your entire savings psychology. You are not just saving abstractly. You are building toward a concrete benefit that will then accelerate your wealth building further. Fifth, once you approach a threshold, proactively contact the bank. Don't wait for them to notice. Call and say you are consolidating accounts and approaching their relationship banking level, and ask to speak with someone about setting that up. Banks love proactive customers who are clearly building wealth. You'll often get better treatment just by demonstrating you understand how the system works. Here is the truth that nobody in the banking industry will tell you directly. These thresholds exist because banks make calculated decisions about where to invest their service resources. Below the thresholds, you are processed through automated systems designed for cost efficiency. Above the thresholds, you are handled by humans incentivized to keep you happy and growing your accounts. It is not personal. It is just math. But once you understand the math, you can use it to your advantage. You can stop being passively processed and start strategically positioning yourself to access the benefits that make wealth building significantly easier. The difference between someone who reaches financial independence and someone who struggles for decades often isn't income. It is not even savings rate, though that matters. It is understanding how financial systems actually work and positioning yourself to make those systems work for you instead of against you. Those three thresholds, $100,000, $250,000, and $1 million, represent inflection points where your relationship with financial institutions fundamentally transforms. The fees that drain your accounts disappear. The services that cost others thousands become complimentary for you. The access that seems impossible suddenly opens up, and the leverage you gain accelerates everything else you are trying to accomplish financially. You don't need to be rich to start benefiting from this knowledge. You just need to understand the game being played and make intentional decisions about how you organize your financial life. Consolidate strategically. Build toward clear thresholds. Use your growing relationship value as leverage, and watch how differently you get treated as you cross each level. If this opened your eyes to how banking really works, do me a favor. Hit that like button and subscribe, because I am going to keep pulling back the curtain on these systems that operate invisibly for most people. Share this with someone who is frustrated with their bank and doesn't understand why they keep getting hit with fees while others seem to glide through effortlessly. The more people who understand these thresholds, the more people can position themselves to benefit. Your financial freedom isn't about luck or connections. It is about understanding the rules of the game and playing strategically. Now you know 3 of the most important rules. What you do with that knowledge is up to you.